You're tuned into Mortgage Ease Unfiltered, beyond rates and real estate. Join your host, Nicole Fruzia. Get ready for real talk and actionable insights to help you succeed.
Hi, everyone. Nicole Fruzia here, and this is Mortgage Ease Unfiltered. Thanks for joining me again on another episode. And in this episode, I want to just go back to basics. Mortgages 101, blueprint basics, just kind of everything you kind of need to know in terms of what that process looks like and some of the more, important kind of factors in this sort of process. And so I'm going to start right by, just kind of getting into where do I think you need to start. And I'm just going to flat out throw it out there and say, guys, talk to a mortgage broker, mortgage agent. Again, that is not for you to come running to be the chat with me. There are so many fabulous options out there, but talk to a mortgage broker. And when I say a mortgage broker, I am talking about an independent agent or broker, not the ones that are at the bank, like the mortgage specialists that work at one of the big banks, for example. Nothing negative to those guys. I am just, my suggestion is that it is best for you to speak to a broker. And right off the bat, that is because they have a ton of different options for you. And so like myself, for example, I don't know what the exact number is. I want to say 62, 63, something like that. We have like a massive amount of options for you. But that's what it is. It is options. And as a mortgage broker, we are very well versed in who does what. You've always heard me say this, and, many times now, that not all products or lenders are created equal. And so again, that is where it is a mortgage broker's job to know this lender does this, you're best suited for this because of your circumstances. And so in addition, there's a few different things they do. So in addition to, again, being the sort of experts in terms of who does what, you're also not going to have access to a lot of those options on your own, for example, right? So like with the big banks, of course, you can walk into them, maybe some of the credit unions. But again, of those 60 plus lenders, majority of those you are not going to have access to on your own as the average sort of consumer. But in addition to all of that, I'm going to just throw it out there right off the bat and say, for the most part, there is no cost to you. If it's traditional financing and sort of regular financing, I can't speak for every, broker out there, but there typically is no cost to you. Now, like, I absolutely love what I do, but I'm not working for free. We do get paid, but we get paid through the lender. So again, with traditional financing, essentially, because we're licensed to do all of the work, we're bringing them the business, wrapping it up to a little bow and taking it over to them. They essentially will pay, a referral fee, a commission, whatever you want to call it. But ultimately, the compensation is coming directly from the lender. And so you, in turn, will have the benefit of having an extra person by your side to handhold you and walk you through that journey, and kind of just go through that process with you. You're getting the perks of course, their experience, their expertise, but we typically will have executive discounts. Different brokers will have different levels. But for example, I have, an executive discount with pretty much all of my lenders. And so what happens is I'm able to negotiate those, rates for you, apply my discounts for you and all of that to help you, make sure that you're getting the most favorable rates. And when it comes to the actual rates and things like that, again, I want to just kind of emphasize that we'll talk more about pre-approvals, but typically, for the most part, the most favorable rates will come into effect at the time of actual purchase. So, when you're going through that initial pre-approval process, like the executive discount that I explained to you, for example, that is going to get applied at the time of purchase. In full transparency, guys, it's because they're like with pre-approvals, it's not real live business, right? There's nothing for us to actually apply those discounts to. And so, just to kind of be, straight up with that, that's kind of what that process looks like. But I want to also speak about the process itself. So typically what's going to happen is you're going to connect with a mortgage broker and, you're going to do your discovery call and things like that. And this, again, is not meant to sound anything negative towards the bank, but the individuals that you are speaking to at a branch, for example, the difference is that there's no licensing requirements for the people that you're speaking to at the bank. So it's a little bit more, again, of a sales role for them. And what I mean by that is that they understand their products. They're speaking to you about their products. But in terms of doing the actual underwriting and paying attention and vetting of your actual documents, collecting all that information, the people that you're speaking to on that front line are not the people that are going to be doing all that. So typically what happens at the bank is they may have asked you for some basic information, and then they may or may not actually, have somebody else look at that information. But 9 times out of 10, guys, that initial process of when you're having a conversation at the bank, most of the time they're, taking your word for it in terms of a lot of the, the information that you're providing. And again, they may or may not send that to a different department. When you're speaking to a mortgage broker, somebody like myself or another agent or broker out there, we are licensed to actually do the underwriting themselves. And so we are paying attention to all of the documents. I've had clients tell me on a regular basis that, your process is so much more, detailed and in depth. You're asking me for a lot more, items. And yes, I am. And I'm actually I'm very proud of that, because that is something that, I'm doing on my side to make sure that I'm doing so much more due diligence to make sure that we're dotting all our I's, crossing all of our T's, and, getting into sort of that, or doing all that extra work for you to make sure that everything is okay. And so I'm going to talk a bit more about pre-approvals, but I just want to emphasize the fact that, on the mortgage broker side of things, that's where, again, we're getting into a little bit more detail. The other big thing is credit checks, for example. And so a lot of people surprisingly don't know this, that anytime you are speaking to, let's just say you want to shop around for yourself, for example, and you're going to go into TD and Scotiabank and RBC. If you're doing an assessment with each of them, or you're speaking to, an individual there, you are going to have a credit check every single time you sort of do an application at each of those. And these are hard hits, guys. So what I mean by that is it actually is impacting your score. And so every time you do this on your own, it is going to chip away at that score. We don't want that. That's not good. I've actually had clients come to me and have like a significant drop in their credit score that they weren't even aware of because they've sort of been shopping around on their own. So that's another sort of benefit of the mortgage brokers as well, too, is that we are pulling with that one credit pull. We're shopping around all of our lenders, essentially, all at once for you. But the last thing I want to kind of say is that when we have your budget in place and when we have that sort of, estimate in place, one of the biggest things with a mortgage broker as well is that they are going to be, there with you throughout the entire process. And so if you are going shopping after work and you want to go put an offer in and it's like 8:00 at night, for example, for the most part, I can't speak for all brokers, but for the most part, you're going to be able to get a hold of your mortgage broker and say, hey, Nicole, I just saw this property, want to put an offer in. I know you told me this is my budget. Can you, take a look at it, tweak the numbers, all of that. And you're going to be able to get a hold of, your broker for the most part. It's not, you're not bound by business hours, we'll call it. But ultimately, I want to emphasize the whole pre-approval aspect of it, right? So, again, going back to the fact that for the most part on the mortgage broker side of things, the pre-approval is going to be a lot more, in depth. And so the whole point of that, assessment is to get a clearer picture of your affordability. We want to make sure that, again, there are no sort of red flags. So I can appreciate, guys, that it might be a little bit more tedious and time consuming for you to go and give your broker all of the extra documents that you may feel that they're asking for. But again, this is all for your benefit. I'm not going to sugarcoat it, guys. It's much harder to qualify for mortgages these days. So the more work that we can do upfront and the more due diligence that we can, give upfront is going to just help you in the long run. Within the first sort of 30 seconds of speaking to a client on a call, I am always telling them that, especially as a first-time home buyer, this is supposed to be a fun process. I want to make sure that you're enjoying this. This is, an exciting experience for you. The way that I can help doing that is to make sure that there are no surprises and no stresses afterwards, right? So the extra work is going to be, it's worth your while. And guys, this is probably the biggest financial, decision you're ever going to make is, purchasing a property for the most part. So give it the effort and the time that it deserves. And so I want to just highlight the fact that there are differences between, there's so many different terms. I'm going to call it a pre-qualification versus a pre-approval. And this will kind of go back and tie back into what I was kind of explaining to you with the banks. a lot of times there is what's called, or what I'm referring to as, a pre-qualification. And that's a lot of times what's done at the bank, or even with some mortgage brokers, some agents, where it's much more limited. It's more of a call and almost a verbal where, a client can say, okay, hey, I make X amount of money, I do this, here's my debt. And, nothing is actually formally vetted in terms of all the documentation. Proof is not, sort of reviewed and things like that. So it gives you sort of a high level kind of understanding. And so for me, that is typically done on an introductory call. So typically I'll jump on a call with a client. I always tell them I have to get really nosy really quickly, ask a bunch of questions. And in that conversation, I'm trying to decide what type of documentation that I would need for them to do a formal sort of pre-approval. But again, in that conversation, that's a bit more of sort of a pre-qualification. Credit is it pulled, things like that, right? So again, sometimes that is done, either online with those online tools, or maybe a quick conversation with a branch, things like that. But very, very highly, highly recommended that you do an actual formal pre-approval. And when I say formal pre-approval, guys, I'm not saying it's formal because you have a piece of paper from a lender or, or a broker or something like that has like a rate hold on it. People really sort of associate pre-approvals with rate holds, like the actual rate holds that you can, sort of hold for 90 days or 120 days. But the most important part is the assessment itself, right? It's the actual vetting of that documentation so that you can go back to your realtor and say, hey, I can confidently say I have X amount of budget, and now we can go out and go shopping. And again, with the broker, what you should be doing is, as you have, let's just say for very easy numbers, as an example, I told you that your budget is $750. If you're working with a mortgage broker, before you actually purchase the property, so if you go out and you find a property today with your realtor, you absolutely love it, you should be calling your mortgage broker and saying, okay, hey, Nicole, I know you said $750 is my budget. We found this property. It's all well within the parameters that you gave us, but can you take a look at this? And that's where we can tweak the numbers, see if we have any, a bit more wiggle room or whatever the case is. Because keep in mind, guys, with pre-approval, it's twofold. And so initially we all get caught up in the fact that, us as borrowers. So yes, we are looking at yourselves and you guys as borrowers to give you a green light and to ensure that, your financial covenants are all there and everything looks good to go. But the other part of that is the property itself. And this is why I can't stress enough. It is so important for you guys to understand that pre-approvals do not guarantee financing. So whether or not you have something from an actual lender and things like that, that is not, it is not guaranteed, because even if you check out as an actual, do you have a green light as a borrower, the lender still has to approve the property itself, right? Because they're lending money based on the fact that you are a borrower. I'm sorry, that you have a green light as a borrower, as well as the actual property itself. And so in terms of going into now that pre-approval as well, just a little bit more, what does that actually, or what are we looking at? Right off the bat, first things first, we are going to look at income. And so there are various different types of income. We have standard sort of employment, which is, you're an employee for a company. In that case, we're going to look at letters of employment, pay stubs, T4s. Fairly simple in the grand scheme of things because, everything is sort of verifiable. And so when we have self-employed income, it's a little bit different. So, and with self-employed, that could be something as simple as you're working for a company, but you're working as an independent contractor, meaning that you don't have taxes coming off, for example. And so regardless, if you're in that self-employed realm, typically what we are going to look at is we don't have, pay stubs and things like that for the most part. So we are going to look at your tax return. So your T1s, which is the sort of document that your accountant gives you once you file your taxes. And so we're going to look at a 2-year average. Here's the key, guys, of your net income. So that is very, very important because even myself as a self-employed individual, for the most part, 9 times out of 10, we are always looking to minimize the amount of taxes that we are going to pay to CRA. So let's just say, for very easy numbers, let's just say you make $100,000. Well, if we are, writing off $50,000 of expenses and things like that, especially as realtors, for example, mileage, all that kind of stuff, if we're writing off $50,000, then we are going to have a net income of $50,000. And we are going to look at a 2-year average. So sometimes it's quite challenging if, we have somebody who's newly self-employed, for example, because keep in mind that in order to have 2 years worth of tax filings, you basically have to be self-employed for 3 years by the time you get those documents, right? So, but nonetheless, all in all, we are looking at income. And again, this is where mortgage brokers are going to be able to help you sort of structure, because certain lenders are better for self-employment income, for example. But nonetheless, looking at income, we are going to also look at your debts. So this is why, credit, your credit pulls are so important. People tell me literally daily, Nicole, do you have to pull credit? Well, yes. And that's because the assessment itself, in order for us to actually tell you how much you can afford, we have to look at your debts. And the way we factor it in is it's typically a percentage of the debts that we see reporting on your credit bureau. So we'll give you an example. Let's just say you have a credit card that is $1,000 and, it's fully maxed. Okay. It's maxed at $1,000. But you tell me, you're like, you know what, Nicole, my minimum payment is only $50. Well, that doesn't matter because I'm not using $50, even though it legitimately is your minimum payment. I have to use a certain percentage of that credit card balance, typically somewhere around 3%, for example. So you can appreciate the fact that I am looking at, what is that? A difference of $300 versus $50, for example. And then all of those payments, or those liabilities, I should say, affect your borrowing power. So it is extremely important that we are looking at your, the debts and things like that you have. And so in addition to that, as part of this qualification, we are also looking at the housing cost itself. So this is where the property will come into play as well too. We're looking at the actual, expected payments, taxes, heat, condo fees. So if it's the condo fee, that's a big one as well too, is that you can have a budget, but if I give you a budget of $750,000, for example, that is going to be based on a certain type of property. So maybe it's based on a freehold property, meaning there's no monthly maintenance fees associated with it. Or maybe if you now found a property that's $750,000, but you come to me and you say, Nicole, hey, but this is a townhouse and it has a monthly maintenance fee. Well, that is likely going to limit and reduce your purchasing power now, because now we have an extra $500 a month in condo fees, for example, or maintenance fees. So again, those are all things that we're looking at. We are also going to look at credit. And this is a big one that most people know about, but I want to emphasize a little bit about what that actually looks like. So the minimum credit score, for the most part, with traditional financing is 680. And I don't want you guys to get too fixated on the credit score itself, because for the most part, there are lenders for sort of every situation, right? But if you are looking to qualify traditionally with prime rates and things like that, you're typically looking at about 680 and above as a credit score. However, even though you may have a credit score that is within the minimum requirements, the lenders are still going to look at your overall behavior. And this is a big one, because I've had people say to me, well, who cares? My credit score is 720, for example. Why do they care if I've had missed payments? But the overall behavior is still very important, because that, previous sort of behaviors are typically, indicate future behaviors. And so lenders will look at that overall, sort of behavior. So don't be surprised if your credit score is good, but myself or somebody else calls you back and says, okay, hey, what was the situation with all of these missed payments or things like that. And then within that as well, I just want to chat a bit about what actually makes up your score. Because the more I talk about this, I find that sometimes people don't necessarily understand what actually makes up your credit score. Most people realize that payment history is, one of the biggest things, like we just kind of spoke about, pay your bills on time, right? But one of the biggest ones that come up on a regular basis is utilization. And this is the next biggest one. I think it's a difference between 35% and 30%, something like that, in terms of what makes up the overall score. So what I mean by utilization is how much like usage is on your card. So let's go back to the very sort of simple, basic example I gave you of $1,000. You want to try to keep your utilization at about 30% and under. So what does that look like in easy numbers with the example I'm giving you? If your limit is about $1,000, you want to try to keep the balance that you're carrying on it, like $300 and less. And so if you find, like myself, for example, I am somebody who uses my credit card for absolutely everything. I go to Tim Hortons, my $2 coffee, I put my coffee, like I use it for everything. I use it because I collect points. That's how I travel. But I use it, I pay it off. I use it, I pay it off. That's a really good habit to have. But if you are using your credit cards and you're using things and you're leaving the balance on there, that's where we want to mitigate it as much as possible in terms of leaving a certain balance. So, something I often say is that if you're not in a position to pay off everything, because let's be realistic, some people use credit cards because they need the actual credit and they need to have that extended sort of coverage of a credit card. And so in a situation where if you are, above 30% and then definitely above 50% of a balance, that is going to start to, your credit score is going to start to creep back down. And it's going to start to, because that's going to be a big, have a big impact on it. So what do we typically say? And this might sound crazy to some people, but if you know that you're not in a position to pay off that $300, for example, and it's just going to continue to increase, what you could very well potentially do is go back to the lender and say, hey, Mr. Lender, are you able to extend my credit a little bit more? And maybe you can have that balance from 1,000 to 2,000, for example. And I'm not saying to do that and suggesting that you go and rack up $2,000. I'm just saying if you give yourself a bit more of a buffer so that you can try to maintain being below that, sort of 30% threshold, that is definitely going to help. So that's just a little trick that sometimes, again, we can, just from an overall credit score sort of, situation and kind of perspective. And then the other last two things that I'll just quickly touch on is credit history. So that is extremely important. And this is another one that I hear about all the time where people will be like, oh yeah, I had this credit card. Like they don't understand why their credit score dropped dramatically, randomly. And it's because they had a credit card for like 20 years and it was their oldest facility and their most mature facility. And then they didn't use it anymore. So they just canceled it. And so that actually impacts your credit score, right? Because again, like one of the things that they're looking at is that they're looking at the maturity of your trades in your credit. And so they want to see if, like the length, right? Like the length and the duration that you've had that credit actually speaks well to you. So by canceling a credit card, I mean, of course, if you're being charged to keep these things and stuff, then you can look at that. But in a situation where, it's good to keep it open at times, right? Depending on the situation. So, and then the last couple things is they will look at sort of types of credit and inquiries as well. So, inquiries is another one because that's kind of goes back to what I actually said earlier, where if you're shopping around yourself and you're getting, a bunch of different credit hits, those are considered inquiries. And again, those will impact your credit score. So something to be mindful of as well. The other thing that is going to impact this sort of qualification, we talked about income, we talked about debts, housing cost credit. Now I want to talk about sort of one of the biggest ones as well, which is down payment. So how much down payment you are going to bring to the table for this new purchase is going to definitely dictate, one, the type of mortgage you have, because if it's going to be less than 20%, for example, it'll be in an insured mortgage, and that's a specific type of product. I'll save that for another episode as well, but it's going to, dictate the type of mortgage that we get. But overall, in terms of down payment, the minimum down payment, and this is something that's often confused, the minimum down payment is 5%, but it's 5% of the first 500,000. And so above that is going to be 10%. And we recently saw increases to that cap. So it's going to be 10% up until $1.5 million. And then anything above that is going to be 20%. So you'll have to have the minimum requirement for, whatever your purchase price is. And in terms of the types of down payments that we can see, most common ones are going to be savings. So money that's actually sitting in your savings or your checking accounts, gifted funds. So funds from parents, for example, And then investments, right? So your own personal funds, but maybe these funds are locked up in investments, for example. And so I really, really want to highlight, because this is such a thing right now. We're actually seeing a lot of problems within the deals themselves because of the sourcing of down payment. And so one of the biggest things, and like as soon as I ask a client, what is the amount of down payment you have available for this purchase, I'm going to say to them, what is the source? Where is this money? So if they say, oh, it's my savings, I'm going to say, okay, hey, well, is it actually savings? Is it liquid in your bank account that you could go take it out right now? Or is it in an investment? And so more often than not, and hopefully it's invested and it's, making you more money and things of that nature. But the challenge with investments is that they are not liquid for the most part. So meaning you have to actually liquidate them. You have to withdraw them. And that is a bit of a process. And so you'd be surprised, but a lot of times it can actually take up to 2 weeks to liquidate these investments. And so, anywhere from 5 to 10 days is typically what I see. Some of them are a little bit faster than others, but this is important for 2 reasons. One, because depending on how quick of a closing you have, typically the quickest closing that we will have is 30 days. And even then you want to be mindful of that. But you can appreciate if lenders need you to be complete 2 weeks prior to closing, for example, and you've got a 30-day closing and it's taking you 2 weeks to liquidate your funds and get all the paper trail ready, because lenders are going to need to see a full paper trail. And this is huge these days. And this is, again, where there's a lot of sort of hiccups. But lenders will need to see where you originally had the source. So again, let's just say it was sitting in, mutual funds, for example. They're going to need to see 3-month statements, so typically 90 days history of where the source or where the funds originally sourced from. They're going to need to see the withdrawal of it, so when you took it out, and they're going to need to see where it went. So if you deposited that into your checking account, for example, and you need to paper trail all of this. The kicker is also that it is literally somebody's job to be nosy in your bank accounts to make sure there's nothing, within those transactions. So it's nothing personal to you guys. This is a sort of a lender requirement. But again, somebody's going to go through your bank statements and see. And so if there was multiple transactions of money movement, it could be something as simple as you're moving it from your checking to your savings to pay something, whatever the case is. But if there's money movement within all of that, that is going to have to be traced and reconciled. And so if now we're involving another account, because maybe it was another checking account, for example, we have to sort of paper trail all of that. So it can take a lot of time. It can be very tedious. And so you need time for these things. And again, this is where we want to do as much as we possibly can and due diligence upfront on the pre-approval stage to mitigate a lot of this. Because if we can do all of that upfront, then ultimately all you have to do is once you've made your purchase or once you've purchased your property, you just have to initiate sort of that potentially that liquidation if it wasn't done yet. And then all you're doing is just that, sort of deposit into your account. So, but it is very, very important that you are, sort of looking at all of that. And the last thing I want to say with that is that typically if you are, let's just assume that you're putting down a 20% down payment, and let's just say it's 100,000, for example. Within typically 24 hours is usually the time frame of when you put an offer in on a property. You will have to do what's called an initial deposit. So your realtor is basically going to say to you, okay, hey, you have to go, we've just signed off. Your offer is accepted. Congratulations. You now have to go pay typically on average about 5% of the purchase price. That's obviously negotiable, but on average, we'll say 5%. So let's just say that's 25,000. You have basically 24 hours to go and take that 25,000 and pay your initial deposit. Now that will form part of the $100,000. But you just have to pay the 25,000 up front, whereas the rest of it you can, pay closer to closing, for example. So the reason why that's important is because if you have all of your funds in investments that need to be liquidated, again, you are not going to be able to go and take that money out within 24 hours because you're going to have to go and initiate it, wait for that to, kind of get deposited into your account. And again, like that can take several days. I've seen it take up to 2 weeks. So that's important to understand. And again, taking it back to the due diligence upfront, we need to understand where that money is so that we can plan accordingly for it. Now, another thing that's going to come into play in this sort of qualification and mortgage process is the rate that you choose. Again, I'm not going to talk, too much about fixed and variable rates, but depending on the difference of those rates, that may or may not dictate a different affordability for you. Because, for example, variable rates are sitting higher than fixed rates, for example. So currently anyway. And so that might dictate a different affordability for you. So again, in that pre-approval process, in your conversation with your financial person, you want to make sure that you're outlining all of this because, if you're set on wanting a variable rate, for example, you want to make sure the assessment is done based on that. The other thing as well, too, is that in this process, we have to do what's called a stress test. And essentially what that is it's a tool that was put in place by the sort of federal government several years back to make sure that, if there was any sort of like something like income disruption or things like that, you did have the ability to still afford that mortgage, right? Nobody is wanting you to be able to default on your mortgage. So they want to make sure that there's a bit of buffer there and comfort there that you can, withstand some potential stress. And so what we have to do is we have to essentially pretend that your rate is 2% higher than the current rate. So it's going to be whatever is the higher of, we have a benchmark rate that we use, or 2% higher than your contract rate. But currently right now, that's what we are using. But nonetheless, you will have to have what's called a stress test. So that's something that your mortgage broker will do, or your, or the bank. And so once we have all of that in place, like I said, you're going to have your budget. The most important part is that whole assessment itself. And then you're going to go shopping around. And like I mentioned kind of before, you want to make sure that, before you put that offer in on the property, that you're checking back in with your financing person just to make sure that everything looks good. Typically, for the most part, your realtor is usually going to have what's called a condition of financing in your agreement. It's not mandatory. Some people will remove that, in terms of being a little bit more competitive. But nonetheless, let's assume that you have a condition of financing, on average about 5 days. That is where now you can actually finalize and formalize your actual financing. Now we actually have a property, so you can go and secure true mortgage financing. And that's where, again, your broker will get sort of updated information if needed, gather all the remaining documents. Then you will receive what is called an actual mortgage approval. So it's not a pre-approval, it's a formal sort of approval in which you have to finalize. The way that you will do that is typically that approval is going to come with conditions. It's going to say, okay, hey, we have to confirm, income, all of those kinds of things. Typically, there is an appraisal. Lenders will lend on the confirmed value of the property. So just because you paid $700,000 for it, if it's not worth $700,000, the lender's only going to lend based on, for the most part, based on what the appraised value is. So again, that's where your realtors are going to be your best friend. They know best. They can look at comparables. And make sure that, you're moving in the right direction, you're offering in the right direction for that purchase price. And so once you have all of those conditions satisfied, we get to what my favorite part is, which is what we consider broker complete, meaning that we are all done on our side of things. And now the next step is going to pass that over to your lawyer. And I will always say, in order to make this a very, fun and exciting and successful process for you, you want to have the best team in place. Your team is going to consist of your realtor, your financing partner, and your lawyer. So the tail end of this is going to now go over to your lawyer. It is very, very favorable if you have a team that, knows each other and can work together. It's not mandatory, but it is really nice, because everybody can, work very, easily with one another. And so ultimately then, you will have, sort of a signing appointment with your lawyer. That's where you are then going to have the remainder of your down payment. Everything that you've now liquidated, you're going to have that. You're going to give that over to your lawyer in terms of whatever those final numbers are. And then on your closing day, the lender will give your lawyer the funds. So if you're working with a mortgage broker, for example, they don't touch the money or your funds at all. It all goes through the lawyer. And ultimately, then that is your happy and exciting day and what we consider your closing day. So that is kind of the gist of it in terms of sort of the rundown on your mortgage basics and what that journey looks like. I hope that was helpful. And that's pretty much a wrap for me, guys. So thank you for lending me your ear, and stay tuned because the next episode is almost here.
Thanks for listening to Mortgage Ease Unfiltered. Hit subscribe and join us as we dive into mortgages, money, and the moments that matter. See you soon!